Welcome in this video where we try to explain what is options, what are calls and puts. Let's try to break this jinx that options are risky. Well, let's try to understand first what is a call and what is a put, and how do we buy a call, or rather when do we buy a call and when do we buy a put, or even when do we sell a call and when do we sell a put. So stay tuned till the end if you want to know the whole matrix of options. First questions first. So when do we buy a call? If your view on the underlying, be it any stock or like Reliance, or be it any indices like Nifty or Bank Nifty, if your view is bullish, you buy a call. And if your view is bearish, you buy a put. So it's as simple as it gets. You buy a call when your view is bullish and you buy a put when your view is bearish. Now, the most important thing in options is that whenever you buy a call or a put, your losses are limited and your profits are technically unlimited. So isn't that great? Well, it sounds too great to be true, but it is true. One more important aspect which most people forget, or which most people don't cover in the textbooks as well, is the probability. We will come to that part little later, that how probability plays an important role, and just not only your risk reward when you buy options. The next part is, when do we sell a call or when do we sell a put? So as we understood that we buy a call when our view is bullish, but we sell a call when our view is not bullish. Now one can always think that if your view is not bullish, agar bullish nahi hai, teji nahi lag rahi hai, that means your view is bearish. Is it the same? Well, the answer is no, because your view could be sideways as well. You might not be completely bearish on the stock or on the market, but your view could be sideways, or your view could be very moderately bearish. So in such a scenario, we don't buy a put, but we rather sell a call. So when you sell a call, your view is not bullish, and not bullish ka matlab hai कि either you are little bearish or you feel the market will be sideways. So that's the time when you sell a call. Similarly, when do you sell a put? So it's the reverse, that when you buy a put, your view was bearish. We have already seen that. So now when you sell a put, that means your view is not bearish. Now not bearish का मतलब है कि आपको ज्यादा मंदी नहीं लग रही है. That means you are expecting the market to be range bound, sideways, or little bullish, little upside you are expecting, you are moderately bullish. So that's the time when you will actually sell a put, when your view is not bearish. So if you've understood this matrix, what I've seen, I'll just show it to you by this 4 quadrants. If you've liked this 4 quadrants and if you've understood what I just said, then do like, share and click on our channel. So now once we know that when we buy a call, when we buy a put, when we sell a call and when we sell a put, another important aspect here which most people miss out is probability. Here, when you buy a call, your losses are limited, your profits are unlimited, but the probability of your trade going right whenever you buy a call or you buy a put is relatively lesser than when you sell calls and when you sell puts. The point is, when you sell calls and sell puts, it looks riskier because your profits are limited and losses are unlimited. So textbook definition से जाओगे तो आपको डर लगेगा कॉल बेचने में या पुट बेचने में, and you will always prefer to buy things. But the probability is a factor which most people don't take into consideration. When you sell, your probability of making profits, though limited amount, is little on the higher side as compared to when you buy calls and when you buy puts. So now, till now, what we have understood is when you buy and sell calls. Let's go to the next step of understanding what is strike price and premium. How does strike price and premium work? For example, in futures, if you were bullish on a stock, say Reliance, and the current price say was 1500, you could just buy a Reliance futures at 1500. But in options, you have various options, as in you can buy a call of various strikes, be it 1500, 1550, 1600, 1700, 2000, or be it on the downside, you can buy of 1450, 1400, 1300, 1200, etc. So there are various strike prices which the exchange determines and gives us for various stocks, and we can buy either of the strike prices depending on our view. The view remains bullish, but you have the option to buy various strike price of Reliance call. Similarly, for puts also, you can buy various strike prices of different puts. So this is what the strike price is all about. Now each and every strike price will have a different price which is quoting, which is nothing but the premium. So for example, the price of a Reliance 1500 call will be different from the price of a Reliance 1600 call and will be different from the price of Reliance 1400 call. That means the premiums of each strike prices will vary. So which one is higher and which one is good or bad? The answer to that is, first you have to understand what is in the money calls, what is at the money calls, and what is out of the money calls. So in this same example, a 1600 call is called as out of the money call. A 1500 call is called at the money call. By at the money, we mean that the current price should be somewhere near to that. And in the money call of Reliance is something like a 1400 or a 1300, which is way below the current price of Reliance. And whereas out of the money was 1600, 1700, or even a 2000 call is like out of the money. So out of the money calls will have a lesser premium than at the money calls, and at the money calls will have a much lesser premium than in the money calls. So your in the money calls will always be quoting at a higher premium as compared to at the money or as compared to out of the money. So now let's understand what are another two concepts, which is time value and intrinsic value in options. The time value of an option is generally there because the expiry is far away and there is still time left in the option. Let's take the same example and let's take the price of a 1600 call of Reliance. The current price is quoting at 1500, so technically 1600 is out of the money and it should not have any value, but still it has some value in the premium. That whatever value is there is called as the time value. Similarly, a 1400 call will not only have time value, but it will also have intrinsic value. So that brings us to understand that what is the intrinsic value. If the current price is 1500 and if we are looking at a 1400 strike price call, then that difference between the two, current price and its strike price, is called nothing but the intrinsic value. So in this example, for a 1400 call, intrinsic value is 100 rupees. So if the call is quoting, if your 1400 call in the real live market is quoting at say 115 rupees, that means 100 rupees is your intrinsic value and 15 rupees is your time value. So this is how it is bifurcated. If I give you an example that 1300 call is quoting at 210 rupees of Reliance in the same example, that means the current price you know is 1500. So 200 rupees is your, out of 210, 200 rupees is your intrinsic value and 10 rupees is your time value. And in the same example, if a 1700 call is quoting at say just 7 rupees, that whole 7 rupees is nothing but your time value because it's already out of the money. So what can we understand from this? That in the money calls have intrinsic value and time value, but at the money and out of the money, intrinsic value is technically zero. So whatever value is there is nothing but the time value. Quite a few concepts like when do we buy calls and sell calls, when do we buy puts, sell puts, depending on your view is bullish or bearish. We've also covered what is a strike price, what is premium, what is in the money, at the money and out of the money calls or puts. Let's understand now that what is the capital required for each of these things. So when do we buy a call, your capital required is relatively very less as compared to when you sell the calls. Whatever the premium is there of that particular strike price ka call multiplied by the lot size is all what you need. For example, when we had understood about futures, for 1 lakh the margin required we saw was around 1 to 2 lakh of rupees, right? Yahan pe to buy calls or puts, you just need a margin even as small as 5-10,000 rupees and you can still start trading options. I don't recommend doing that, but the tool is available to buy even if you have just 5 to 10,000 rupees in your bank account. Now comes an important thing, that what is the margin required when you sell calls or when you sell puts. So the margin charged on the futures contract is similar to the margin charged on the options selling side. So generally this makes people think that फिर sell करने से तो buy करना ही better है because the capital required is less, which is true that capital required is less. But if the call at every month becomes zero or the put becomes zero, if your call doesn't expire above your strike price. Say in this example, if you would have bought a Reliance 1600 call just because it was quoting at 10 rupees, and if say the price of Reliance is, the lot size of Reliance is say 500 shares. So 500 into 10, that means with 5,000 rupees you could have participated in it. But if Reliance doesn't close above 1600 in this expiry, that means your whole 5,000 is lost. Same way, say if you would have sold a call for 10 rupees, you maximum profit is only that 10 rupees, of course multiplied by the lot size, which is 500. So 5,000 profit you make. The probability is higher, but the profit is lower. In buying options, your probability is very low that it will cross 1600. But at the same time, your loss amount is only limited to the premium price. मतलब 10 रुपए का प्रीमियम खरीदा है तो उतना ही जाएगा, 20 रुपए का खरीदा है तो उतना ही जाएगा. तो you can indirectly say it is like a lottery ticket. कि when you buy a lottery ticket, maximum what you can lose is how much you've invested. You can't lose more than that if you are a buyer of a lottery ticket or if you are a buyer of options. But in selling, you can lose unlimited if you don't keep a stop loss. So especially when you are selling options, one should always and always keep a stop loss, if your trade goes against you. So now how much capital required for buying and selling? We've also covered that. That means that leads us to that we have covered कौन सा call या put खरीदना है when you're depending on your view. How much is what is the strike price, what is premium, what is intrinsic value, time value, what is at the money, in the money, out of the money. These all topics we have covered, along with that what is the margin required. Like in selling options, we discussed that the whole futures margin is required and a little less than the futures margin, but almost like a full margin is required. And in buying options, you just have to pay the premium value. Another important thing, especially for the portfolio people, like means people who are trading with a huge portfolio, when you sell options, the margin required can actually help and you don't actually need a hard cash to be there. Whereas when you buy options, definitely you will need the full amount to be paid as the premium. That means even if you have your stock, if you have 1 crore rupees stock and if you are buying 20,000 worth premium, it will not suffice. You will have to deposit that 20,000 rupees. Your stock portfolio won't be able to cover that. Unlike when you are a seller of options, when you are a seller of a call or put, if your portfolio is there, it is sufficient and you don't need actual hard cash money to sell options. Many people ask me, what is this Black-Scholes formula? There are various other terms also which I have heard people asking me, that what is this delta, vega, gamma, theta, IVs, volatility. All these things help you to determine the price of the option. And we are not trying to determine the price. जो अपने को screen पे दिख रहा है, that premium is final for us. We are not trying to see if the premium is mispriced or not mispriced. अपने लिए भाव भगवान है वाला कंसेप्ट है कि whatever premium is quoting is right. So we trade based on our view. We don't try to use Black-Scholes or we don't try to use IVs and जिसको Greeks बोलते हैं. We don't try to use that. We try in our strategies to have a view whether it is bullish, bearish, sideways, not bullish, not bearish. Depending on that, we frame our strategies. In this video, if you actually liked the basic concepts like what is a call, what is a put, when do we buy calls, when do we buy puts, when do we sell calls, when do we sell puts, what is strike price, what is premium, what is in the money, at the money, out of the money. If you have cleared all your basic concepts, please do share, like and subscribe to our channel. Thank you.